Okay, as promised in the first video, I put the first video after the note-taking sheet and the slideshow. I also put a link to the first video on this slide, and I put a link to the video. Well, I put it in the main one here, so it should be in yours. I guess I could do that now. If you ever want to put a link, this is what you do. Copy the URL, and then you scroll over where you want it, and then you right-click, and then you choose link, and then you paste it with the Control V. Then you choose apply. Once you see it turn blue, you know it's in there. Oh, I didn't like that. It's not beautiful. So let's fix it. All I gotta do is remove it, put it back in there. It looks funny. It is funny. That would drive me crazy. All right, now it's gonna be clean. All right, so let's continue where we left off. We finished the first 23 slides on day one, basically. So we're picking up on slide 24. And basically, we're going to cover 6.5, 6, and 7, which will be investing, bonds, stocks, and other financial assets. So let's get there. So we're here. 24, 6.5, slide 34. All right, the big questions. How would you describe the term investments? It's basically using money to make further assets or profit or income, whatever. What are financial intermediaries? Those are people that are middlemen, basically. The purpose is to facilitate business. Explore the concept of risk and return. Risk is how likely is the investment to pay off or become worthless. Return is the amount of money returned on your investment over how long of a time. Private enterprise and investment, the use of assets to earn future income or profits. Piggy bank, savings. When people save or invest their money, their funds became available for business, for use to expand or grow. Investment is basically economic growth. All right, so let's go ahead and add the notes. Okay, so I have to escape out of there to do that. And again, if you didn't set it up side by side, I suggest doing so. If you put the slideshow and the video next to each other, then use the tab resize here. It'll set it up nicely for you. Use of assets to earn future more profits. Yeah, it takes a while when you're using money to make money. That's why they say the rich get richer, because it's true. Because it takes money to make money. And you got to risk it to get the biscuit. That's where all these sayings came from. But you don't want to be too risky, and you don't want to be so conservative you miss opportunities either. Financial system. When you hear that kind of talk, they're talking about overall big picture stuff. And it allows the transfer of money between borrowers and savers. So you got one group of people saving money for retirement and whatnot. And then you got one group borrowing money to reinvest it. These are the entrepreneurs, and you got American Express, like in the middle of all that, or Citibank or whatever. This document confirms claims on property or income of the borrower are called financial assets. So it'd be like, I don't know, stock, bond, mortgage, business, car, boat, something of value, bond certificates, passbooks, those count as income too, investments. All right. All right. So let's add our notes. So financial, they basically set up the transfer of money between borrowers and savers. Documents that confirm your assets are, it's basically confirming your claims to have certain monies. So like when you go to apply for a mortgage, you have to make proof of all your savings accounts, your checking accounts, how much you owe and whatnot. They want a lot of information. So what you say you can afford, you can prove. And then basically you got to show your income. And you just got to prove you're worth with what you say you're worth. Okay. More specifics on financial intermediaries. These go-betweens, these are institutions channeling funds from savers to borrowers. Examples: banks, savings and loans, credit unions, finance companies. It's going to be hedge funds, mutual funds, life insurance companies, pension funds. It'd be like CalPERS would be a big one. That's the California Teachers Retirement Fund. And it's a big one because there's a lot of teachers in California. Financial intermediaries take funds from savers and they make loans to investors. So Citibank will take my savings account or my, I don't know, CD, and they'll get that money working through some kind of investor. And as middlemen, they take a fee on both ends. Mutual funds, hedge funds, they earn life insurance, they all earn money through fees. So they're entitled to some profit for their service. With a fair profit, though, that's where people start getting disagreement on, because you want ethics. It has to be worth someone's while to do that kind of business. So it's complicated. We're writing in the notes as we go. Let's go ahead and write these ones in, and then we'll read it through it. Services provided by those financial institutions. You're talking again the banks, savings and loans. Ooh, I don't like that. Fix that. Hanging comma. No bueno. Let's go ahead and fix the original note. So you don't see that. I don't have to say ew again. All right, there we go. That's another reason why I do it. So I like to make it just right. All right. Services provided by sharing risk, diversifying investments. In this case, we're talking diversification. So go ahead and type in diversification into your notes. And then we're gonna, and you spread out investments to reduce your risk. You don't want too much risk. You don't want to be too conservative either, because then you could miss a good opportunity to profit. You want the right amount of risk for you. Portfolio. This is like like a folder of all your assets in one place. Everything I got, I can prove it to you in one little folder. It might be a big folder, might be a small folder, but they call it a portfolio because it's all your various investments and assets. Providing information. Save time and money researching investment for clients. Okay. So another service they perform is giving information to the people that are borrowing or um, saving. And they use a prospectus. This is like a proposal for borrowing or saving. And it's a government required report to make sure everything's on the level. And sometimes you might have to provide some form of good faith with some liquidity in some of your cash in play. All right, let's look at this, make sure we didn't miss anything. Slash covert again. Sharing risk. So the intermediaries help the sharing of the risk, diversifying investments. When you diversify, you could have some risky elements in your portfolio and some conservative elements in your portfolio, like the CDs, um, relatively, in the bonds tend to be less risky. Mutual funds a little bit more risk, and stocks the riskiest. But then also stocks the most profit, mutual funds probably the second, etc. Bonds have good tax avoidance on the property if you can do that, because that ties up some of your money. Portfolio is a collection of one's financial assets. Providing information saves time and money researching investments for the clients. So they want certain information from both the borrower and the saver. And this prospectus, again, it's a government required document. And liquidity converts the investor's assets into cash easily. All right, risk and return. Risk. Would you like to play a quick game of Risk? It's an old joke because Risk takes forever, just like Monopoly. Return is the amount of money the investor receives above the amount initially invested. Return is the profit. The greater the liquidity of an investment, usually the lower the return. Okay, basically, um, the, the more it's soft money, they usually get a lesser return. The higher the potential return on investment, usually the greater the risk involved. So, like, that's where the saying "no free lunches" comes from. Because the higher the risk, the greater the reward. But with the risk becomes the potential of losing it all. It's not like you're just boom, you're just perfect just because you make a risky investment. No, risk is not always good. You have to know where you're at. Like when you're 30 and say you have $30,000 lying around, that's the time to be more aggressive. You'll have another 30, 40 years of making money. When you're 80, that's not the time to be making risky investments. So it depends on life situation too. So you got to be honest where you're at in your life. There's this growing thing as people's longevity is increased, that people have lived longer. You can outlive your savings, and so that has created some hardship in elder poverty, um, because basically you're kind of guessing how long you live, and what if you end up living to 100, but you thought you lived to 85, and you spent too much money. So what do you do? I mean, it's rough. All right, that wraps it up on investing. How would you describe the term investments? Investments are using assets for investments are using your assets to gain future profits or income. What are the financial intermediaries and what is their purpose? Financial intermediaries are those that work to get the money from the savers. Financial intermediaries take money from savers and they get it to the borrowers through savings and loans, hedge funds, mutual funds, etc. Their purpose is to provide information and um, they're also allowing for diversification or risk sharing and to provide liquidity to the from the saver to the borrower. explain the concept of risk. Risk is the amount of assets um, involved in a transaction, and the return will be contingent upon the risk. The higher the return, the higher the potential risk. Um, but with the high risk, you might actually lose money. Not to mention not have no return, any return. All right. Go ahead and write that up. Pause while you're doing so, and then just hit play again, and we'll continue. The next chunk of notes. That wraps up investing. Moving on to bonds, stocks, and financial assets. Some key questions here. The big questions are: what are the three basic components of bonds? Describe the different types of bonds. How are asset markets classified? What is a stock? And explain bull and bear markets. Okay. Bonds are loans or IOUs that governments or corporations must have to repay investors. So it's a loan, but instead of getting your loan from a bank, or it's a private loan by investors. And people are saying, like, I'm going to let Amazon, I'm going to let General Electric borrow this amount of money for this amount of time. I'm going to let the state of California or the city of Sacramento, uh, and because I know I'm going to get a reasonable rate of return. And there's three basic types of bonds that you can invest in. Uh, there's three parts of a bond. There's a coupon rate, which is the interest rate that the bondholder will receive over the life of the bond. There's a maturity time when the payment to the bond holder is due. At some point you could have a 1 year bond, a 5 year, 10 year. But at some point they're going to have to pay you back. So, say you're looking for a tax-free investment, a bond could be a good look if you know you're going to want maturity in 10 years, or like when your kid is going to be in college. Like, so my daughter's 8, so like a 10-year bond would kind of be perfect right now, me and my family, if we had the money to invest. Par value, that's the amount of the original investment. It's what you're paying for the bond. So par is basic level. Par is it's not good, it's not bad, it's what you put in. And in golf terms, it's the same. Par is like the average expected score on a hole. So that's how they're using it here. I don't like it when they carry over. If they're like close to the beginning or end, I just roll them over to the next one. All right, bond ratings. Let's go back and make this one bigger and then look at the next one. Notice I mix it up. That's what a bond looks like. It's a corporate bond. There's always some kind of Americana. See an eagle here, and then you have some laurels to make it look fancy. And again, three parts of a bond: coupon rate, your interest rate, and maturity when it's due, and the par value. Some bonds can be traded before maturity on the bond market, so you can buy and sell them. But it's kind of a niche, kind of a small enterprise. Bond ratings. Standard & Poor's and I think Moody's, they rate the bonds, and they have these books that come out every year. And they go, okay, this bond gets a AAA rating. It's the highest rating because it's the most reliable. Might be a good government bond if you know the city or the state is well funded. But if the city and state are not well funded, or if they've defaulted before, you might not have to get that AAA rating. AA is a pretty high grade. A is upper medium grade. Triple B is a medium grade, and then you got the non-investment grades, and that could be B's and C's and D's even. And these are default or junk bonds. Some people like that because they get a higher return, but it's risky. What if they default? What if they don't actually pay you your money back? And get your par value back. So there's a risk to trying to make extra profit, and the risk is you lose it all. All right, let's go ahead and take the note here. And we're going all the way to 44 in the notes, so we'll see how it goes. So these are the companies that rate the bonds. So we got our AAA as the highest rating. You got your default or junk bonds. Junk wall caps. Grumpy sometimes if they're digitally owned. I think that should have a dash in it. Some people don't mind the risk with their investments, but those people have more money than most. Most people mind too much risk. All right, types of bonds. There's three kinds. You got a savings bond, you got a treasury bond, and a municipal bond. Those are the three main types. Savings bond tends to be in smaller denominations, in the $50,000 to $10,000 range, and it tends to be um, issued by the government, and the interest will be paid on the maturity date. So it's pretty reliable. Treasury bond, these are bills or notes paid by the U.S. Treasury. They're called T-bills. Municipal bonds, those are city bonds. Whether it's city or state, call it municipal. And uh, that's the money used to make highways, schools, libraries, because they're going to want future loans. Cities and states tend to repay these at a high rate. These are pretty reliable investments. The important thing for the investor is not really the rate of return, it's the tax. Even though sometimes it can be pretty good, um, they're exempt. The U.S. bonds are exempt from all taxes, and that's important because you wouldn't want a state driving U.S. bond out of business. But the muni bonds are exempt from federal taxes, so that makes it tend to be a pretty good investment. All right, look at this in detail. See if we missed anything. We got it all covered. And then go to the next one: savings bonds, low denomination. I know $50,000 to $10,000 might not seem low to you, but when people are talking about investing thousands and thousands, you can see it as a little bit lower. Interest tends to be paid on the maturity date, tends to be reliable. Treasury bonds, it's U.S. Treasury Department. You can see exactly how much money you're going to make on those ahead of time and how long you won't be able to access that money. And then you got municipal bonds issued by state or local governments for improvements, usually highways, schools, libraries. It's usually to infrastructure. The tax is the key thing, though. Those being exempted from taxes, it's a good way to make money and not be taxed on it, especially if you're in a higher income bracket. There's a few more types of bonds. There's corporate bonds. These are issued by corporations to raise money. I don't like that. That's a big guess. Fix that. Looks that'll drive me crazy. So, if a corporation is trying to expand its business, they might sell some bonds and give a return of money at a certain future time to raise capital. Everyone needs capital to expand. Junk bonds. These are lower rated bonds, but they have a possibly higher payoff unless they fail out. Um, some some investors got some big reputations by selling junk bonds. They made a lot of money, but they defrauded people and they ended up going to jail because what they said about the reliability of the investment wasn't true. These are below investment grade and they're high risk to lose it all. A lot of people that put their money in these junk bonds, they lost all their money. And so when Milken went to jail and his cronies, and not all of them went to jail, I don't think either, but Milken famously in the 1980s was selling these high yield bonds, and he goes to jail for 2 years and kind of took all kinds of people's life savings, and so it's kind of a joke. And the jail he went to was kind of a country club. Not that I want to go, but given the harm he caused uh, the other folk, people were kind of upset that his penalty wasn't worse. Um, Milken's kind of a famous guy, so if you're curious about him, give him a Google search when you get him a minute. I wouldn't say now, though. Stay with this right now. When you go to jail for fraud, you're like not really disclosing everything you're supposed to. So, yeah, it's kind of bad. All right, got about 10 more slides to go, about halfway. Certificate of deposits. How long have we been in? Oh, 25 minutes. So I might pick it up a little. Other financial assets. The certificate of deposit, notice that's an acronym for CDs. So just running CDs right here. They're available through bank funds deposited for a fixed amount of time. CDs tend to be 3, 6, 9, 12 months, 18 months, 2 years, 2.5 years, 3 years. The longer you commit to it, usually the better interest rate you get. Then you have your money market mutual funds, which basically could make more money, but it's slightly risky. If the market takes a downturn, you might make less. But they're not insured because you're basically playing on the market. So what certificates of deposit are. So if you're looking for safe, CDs are better. If you're looking for a higher return, money markets are good. Generally, the rule of thumb is before 50, be risky. And after 50, play it safe. That's generally the rule of thumb. But everyone's comfortable based on their understanding of things. Generally, money markets are going to make more money, but because people just invest in the same thing because they don't want their money market not to bring more money, so then they're not going to get the investors in the future, so they're self-motivated to do well. Classification of assets markets. This is according to the length of time for which the funds are lent. The longer the money is loaned, usually the higher return. Capital markets, money lent for longer than a year. These are your CDs and your corporate bonds. Money markets tend to be lent for less than a year. So if time is an issue and you're looking for short term, you might go with the money market or a T-bill. If you're looking for longer term, you might go with CDs. You might get a better rate. You really want to shop the rates. You're looking at where to put your money. This is let's say I'm going to buy a car, and I know I want to save up for a year. I might stash my money in a CD. Anything left over I have in savings, because I know I want to save up for X amount of time more. And then you probably want to get a super savings account too, because the other money you save in the interim, you want to get some kind of rate of return on it. But that's kind of low right now because the interest rates are so low. So you really want to watch where you're keeping your money. If you accrue some of it, a significant amount. If it's not that much money, it doesn't matter. If it's significant, though, you should look. This is according to whether assets can be sold to other buyers. These are primary markets where assets can't be transferred from the original owner because it's connected to you, like a savings bond. Then you get your secondary markets. They can be resold, whether it's you're talking about stocks or bonds. You can definitely resell them. All right, so let's add the notes. So when we're talking capital markets, we're talking longer than a year. We're talking CD and corporate bonds. When we're talking money markets, we're talking shorter terms. We're talking shorter term CDs. We're talking mutual funds, T-bills, etc. We're talking primary markets. We're talking one. Primary is one, like main color. red, blue, yellow, green, and they're not transferable. I transfer my savings account on to someone else, it's to me. Or, and if I'm married, it might be to me and my wife, but it doesn't go to a million other people. It can just be. But if you want to be invested in something where you can resell the things, stocks and bonds are your choice. All right, buying stock. Corporations sell stock to raise money. A good way to raise money. All you got to do is say, "Hey, you can own some of my company because I'm offering this number of shares of my company for sale." Share is a portion of a stock. It's not even a full stock. So a full stock would be a specific percentage of a company. So it's a share of a stock. So it's really a partial ownership. Stocks are also called equities because equity is something that has value. Look up the term equity. And it's supposed to be fair. Value of the shares is issued by a company. You're basically a fair price on the share. That's why it's called equities. But it's also synonymous with a stock share. Profits are earned two ways. Dividends. If you just have a stock and you're in a good company and the company does great, they might just give you money for being a partial owner. Disney did this. Other high profile companies have done this. And guess what? People want to buy it more, and so the value goes up. Capital gains. When a stock is sold for more than the purchase price, you don't get capital gains when you lose money, only when you gain money. So let's say you bought Amazon early and you got it for $10 a share, and now it's worth $1,000 a share. You bought 10 shares, boom, you just made $10,000 on your $100 investment. So you made $9,900. Woohoo! But you do have to pay taxes, capital gains. There are loopholes in it that people use to get around this all the time. Let's see what else is on here. Let's go forward. Dividends, capital gains. That's the two main ways you want to make money from stocks. And again, it does symbolize an ownership interest in the company. You own enough stocks, you can control the company. There's the four main types of stocks. You got income stocks, which pay regular dividends. You got growth stocks, fewer no dividends, but the earnings can get reinvested. You got common stocks, where stockholders are voting owners, and preferred, where they're not voting, but they receive dividends first. So those are the four main types. Most people are I'm a stock expert, but it depends what you're buying it to. If you're buying the blue chippers, you're more likely to get the dividends. But if you're buying the NASDAQ or you're buying the penny stocks, you're less likely to get the dividends. That much I know. The rest, I'm not an expert. You take these notes. Income that pays regular dividends must be nice. Because then you keep your investment too. You can still sell it off eventually. But yet you're still making money on it in the interim. So why get out? The answer is you don't get out. You just stay in because it's doing so well. Do you want to sell Disney? Nah. You think Disney's going to keep growing? We're going to keep paying you your dividends. And you're like, yeah, give me some dividends. Woo-hoo. So yeah, that's how it goes. All right, let's go to the next one. Splits and risks. Oh yeah. Disney famously did a split. A split is great. A split happens when a corporation that's publicly held is worried that the price of their shares are getting too high for investors. So they split the value of the current shares to devalue each stock. And it's great for the investor because now the number of shares I have, and they might split it into two or they might split it into three, usually not four, usually two or three. And so then you get twice as many or 3 times as many stocks as your original investment. So say my stock split and I had 100 shares of Disney and they split it 2 ways. Now I have 200 shares of Disney and the value just went down $100, not all the way in half. So it's good. Oh, by the way, this is a visual of a log splitter. Stocks are riskier investments than bonds, but they also have a higher potential for earnings because it's not like set for a certain date, and because each corporation and investment, there's so many out there, it's hard to track if one really is good or not, and or are you hitting it at the right time to invest. Everyone knows Amazon's worth a lot now, but Disney is probably down because of COVID, or everyone knows that the people that made the mask made a lot of money, but are the masks going to go away now that the vaccines have hit? So then, what do we know hit? Pfizer, Moderna, Johnson and Johnson. They did well because they made the vaccines, and so you got to keep looking at what's going on in the world to look at what's the better investment. Um, so let's go back to our notes. Share divides into 2 or more shares because price comes to. Stocks are riskier investments than bonds. That's true. And yet the potential for earnings is higher too. So higher risk, higher reward, but then you can lose it all. It's possible a company goes out of business that this thing happens. And so it might be totally worthless. And that'll bum you out. Trading stocks. The main person that trades the stocks is called the stockbroker. Stockbrokers work for brokerage firms. They broker the deals, set things up. That's what that means. And they specialize in trading stocks. This is, I don't know, Charles Schwab, Merrill Lynch, these kind of companies. Stock exchange are markets for buying and selling stocks. It's the place where the broker goes to exchange, buy and sell uh, these these uh, these valuable shares in corporations. And there's a few World Stock Exchange, the New York Stock Exchange, you got the London Stock Exchange, Tokyo Exchange. There's a few of them. I think there's one in Sydney. There's a Sao Paulo, Brazilian one. Okay, you see on the map. There's a few. I don't know if clicking that would work. But these guys basically are the ones on the phone saying, "Oh yeah, you heard about this company? Have you heard about that company?" And tech was big for a while, and then sometimes the tech companies flame out. Sometimes they hit big, like Apple did, like Microsoft did, Intel. So, but not every company is that. Otherwise, you'd know exactly who to invest in. New York Stock Exchange. This is the largest stock exchange on the planet. Only the major companies are invited to trade on the New York Stock Exchange. Your kids on the block. They're on Stock Exchange? Oh, that's cool. Go get it, new kids. Uh, that's funny. Um, Nasdaq's Amex, they tend to focus on high tech energy stocks. They're a little bit less valuable, but they can be popular at times because the tech market is growing. OTC market, that's the over the counter market. These are electronically traded stocks and they're not listed on major exchanges. These are the ones um, probably that where you'll find like E Trade and that kind of thing. So easy a baby can do it. Yeah, I don't know about that. Babies can lose money too. Day trading. These when you hear about day trading or day traders, they're trying to predict minute by minute changes in stock and they're trying to get a quick profit. Generally, if you're in it for the long haul in the market and you get a good company to invest in, you'll make money if you can wait it out. In the short term, it might go down, but if you can wait it out long enough and only sell when it's up, you'll be fine. If you get impatient, then you're going to take losses. Or if the company is suspect, or the company has a downturn, or tech runs them out. Like you wouldn't want to invest in Blockbuster, but and there was a time Netflix was booming. I don't know if Netflix is dominant anymore because so many streaming services have come online of late. So these are the kind of things you got to think about. All right, let's add our notes in. NYSE is the abbreviation for the New York Stock Exchange. NASDAQ tends to be high tech. I don't know what that says. I think it stands for security, data, and I don't know, something like that. It's something that's techy. NASDAQ. I could look it up. I think I've been going on and on. Anyway, but there's only 3 more slides, so let's look up what NASDAQ symbolizes. NASDAQ definition. National Association of Security Dealers. Okay. All right, fine. Over the counter again, those electronic ones. Day trading. A friend of mine who's into it, he's a doctor. He told me it's not too hard to get into investing in stocks. Be a nice little hobby, as long as you don't get carried away, and especially if you think long term. Futures. These are contracts to buy or sell commodities at a specific date in the future at a price specified today. So basically, you're betting that the future price is going to go up, or you're betting that the future price is going to go down. And you can go with options. Contracts give investors options to buy or sell the stock. So if you're going to bet that the price is going to go down, you're going to want to be able to sell it at the current price. If you're going to want to buy it. Wait, if you want to buy it if you think you can get a lower price in the future. So basically, you're guessing on, is the value going to go up or down in the future, and you can choose a call option. That's when you're going to buy at a certain future date. A put option is to sell at a future date. You're going to want to put if basically you think it's going to go down, and you're going to want to call if you think it's going to go up. That's basically the deal. But you could be wrong, so it's kind of risky. But then if you're right, oh, you can cash in nice. Okay, so that's what options are. Futures are, you're basically predicting future value. Commodities can be, I don't know, it can be pork bellies, it can be gold, it can be diamonds, it can be, I think, citrus is another one. There's all kinds of commodities, but it's a specific good. It's not just random stuff. It has to be a specific good. Call and put are options on stock, like you're making a prediction. I think this is what caused that bubble. I don't know if you followed that bubble, but there was this thing with Montgomery Ward, and I think we're going to do a lesson on that when this unit's over. But it's basically I think it was GameStop. There was this run on that basically investors said we're not going to let it fail, and it didn't fail. When you hear there's a bull market, the market's doing well. It's running out of control. Think of the bulls in Pamplona. Festivali San Fermin. I went. It was pretty cool. I did not run with them though. Those bulls came pounding through the city. So it's actually really kind of a small village, but it was super fun. A bear market, it's falling. Think of the cupboard as being bare in a bear market, and that'll help you remember that is a negative indicator. Stock performance indicators. The 2 main ones are the Dow Jones Industrial Average. Dow Jones Industrial Average is a number. They take the top 30 stocks, and then they divide it, and or they come up with a number, and that maybe they just add it. Anyway, they have this number, right, and then you can see are the top 30 going up or down, and so it's pretty elitist. But S&P 500, they look at the top 500 different stocks, or I don't even know if they're top, but it's 500 different stocks. And they're looking at the value to determine if things are going well or poorly. Let's see if I cover everything. Wall Street loves a bull market, hates a bear market. That's why you got a bull in Wall Street here. And they are up because it's doing well. Dow Jones Industrial Average, top 30 stocks, S&P 500, 500. The great crash. There was a major stock market crash in 1929, Black Tuesday, October 29, Black Thursday, and it was because of too much money was borrowed to buy goods. People, too much credit was given out, especially on stocks. People are buying stocks on leverage, meaning they would pay 10% of a stock, and if it went up, they cashed in the profits. But if it collapsed, they couldn't afford it. This is showing you that the stock market can be a roller coaster and it could crash. Here you see hungry people in a soup line that were once proud working folks that had money. But the crash caused a lot of unemployment. Another reason why it happened was speculation, too much borrowing money to invest in high risk stocks, not the blue chip risk. The effects of the crash, you had high unemployment rates, people lose their jobs and homes and farms, and it was awful. All right, that's the last note. Good job. So let's talk through slideshow quiz. Then we'll call it good, and you can turn these in. Borrowed to buy goods. Speculation. Speculation is prediction, guess on the future. You're always speculating on the future value of stock. You're predicting that it's going to go up when you buy. You're predicting it's going to go down when you sell. Otherwise, you wait. Sell. All right, what are the three basic components of bonds? I don't know. That was a while ago. So let's look. Coupon rate, maturity, par value. Remember, I got to write a sentence or you're not going to get credit. If you just wrote maturity, coupon rate, maturity, par value, you would miss all of this. So, three basic components bonds are coupon rate, maturity, par value. Different types of bonds. That's the look. Don't need this anymore. It's bigger. Different types of bonds are corporate, different types of bonds are savings bonds, treasury bonds, municipal bonds, corporate bonds, and junk bonds. Different types of bonds are savings, treasury, municipal, corporate, and junk. So I think that's fine. Back to the answer. How are asset markets classified? Asset markets are classified as capital markets, longer than a year, or money markets, less than a year. Asset markets are always also classified as whether the primary markets, where it goes with one or two people, or secondary markets that can be resold to the public, like stocks and bonds. What is a stock? A stock is a share of a corporation. Explain bull market and bear markets. A bull market, the market is rising. The market's value is increasing. In a bear market, the market's value is decreasing. Write that up in complete sentences, get that submitted, and you're good.